Now, I guess this was primarily driven by higher gold sales, which led to a $47 million increase in gold revenue. And there was also a nice jump of $24 million increase from third-party limonite sales. Obviously, these gains were partially offset by lower contributions from some of the nickel downstream products and the copper segments, which resulted in a slight decline of 7% year over year. In terms of the nickel business, we sold 1.8 million tons of limonite, which is a 54% increase, and overall satisfactory performance in terms of some of the downstream businesses. In terms of the project update, we're actively de-risking TB Copper project, which we can touch on a little bit later, and that will feature a larger ore reserve and a 50% increase in the sub-level cave throughput. The construction activities at Pani is progressing well, 49% complete at the end of March, and about 65% as of last week. So on track to start project commissioning towards latter part of 2025. At the HPALs, we continue to ramp up the operations at PTESG. So the train A commenced operations in late 2024 and is achieving nameplate capacity of 20,000 tons per annum. And we're in the process of commissioning train B, which is an additional 10,000 tons per annum. And in terms of the AIM plant, we continue commissioning activities, and ramp up of the copper cathode plant is progressing, and we should be in a position to realize the full potential of the AIM plant within 2025. I might pass over to Teddy just to chat about the nickel operations in more detail.
Thank you, Stan. So on the nickel side, I think I'm not sure if I illustrate this in the previous call, but we do expect the nickel operation to be very second half loaded for a couple of reasons. First is, if you looked at even last year, there was a seasonality because of weather. So that we cannot escape, right? So second half would always be higher compared to the first half. Second reason is for the second half loaded is because, as I mentioned, I think we mentioned this also a few times in the past, that in the first half, BSI, one of our RKEF, one of the train is still on overhaul. So fourth quarter, second half last year, fourth quarter last year, one train was under overhaul. That's already now under ramp up in the first half this year, in the first quarter this year. However, the second train is on the scheduled overhaul. On top of that, ZHN, which is our larger RKEF, undergoing minor maintenance. So it's for all 4 trains, it's about 2 weeks each. And as a result of that, you'll expect later part of this year, in the absence of the overhaul and the maintenance, that should give us a better volume. On top of that, ESG, the FPP slurry pipe is expected to be connected later part this year. So when you combine all that together, obviously the mining part will also be second half loaded, because given that the RKEF are on overhaul, we are not going to send as much product of our saprolite to the stockpile as a result. Likewise for the limonite, as we will be awaiting for the ESG pipe to be connected. In terms of the performance this year as well, we also expect that the AIM expected to have a financial impact rather in second half, or rather in mostly fourth quarter this year. So that adds into the loading up of the second half performance over the first half. Sorry, Stan, I think these slides is, yeah. Probably this is just as I discussed before on the nickel operation. If you go to the next slide on the NPI, as mentioned previously, the NPI obviously expected to be more second half loaded given the operation that's undergoing. Next slide, Stan. So on the copper and gold production, the gold are pairing pretty well on the year-on-year basis. As you see that the gold production went up by about 6%. Gold sales went up a bit higher, considering the favorability of price. We also supported by the higher stack rate, up from previously 0.4 to 0.44. However, at the bottom, you'll see a decline in terms of the copper production. That is the decline given or induced by the phasing down of the Weta production thus far. Next page. I'll hand this over to David.
Thanks, Teddy. Okay, so this slide really looks at each of the individual operations and calculates the margin for each of those operations. The first column is the nickel ore at SCM. You can see that during the first quarter we had lower volumes, and because there is an element of fixed costs, those lower volumes translate through to slightly higher cash cost per ton of ore, and the nickel price has been down over the first quarter. So overall, the margins are lower than what we think the long-term trend in margins will be for both of those two operations. The saprolite margin is the internal transfer price between the mine and the RKEFs. It is not recognized as revenue because it is two consolidated entities. The price is the Indonesian government mandated price rather than market price, which is higher than what's shown here in the ASP of 25.8. Stan, can you expand? Go back one, please. Thanks. MPI margins continue to travel at about the same level as they've been during 2024. Overall, the NPI price has been up during the first quarter, and that has put some pressure on high-grade nickel matte in terms of margins. So we've had the nickel price coming down and the NPI price being up, which has meant that the overall cash margin for the first quarter has fallen to $242 per ounce. And given that low margin, we took the decision to temporarily close the high-grade nickel matte plant, and as prices recover and we have more margin for the high-grade nickel matte, then we can reopen the high-grade nickel matte plant. Gold business had good margins for the quarter, 66%, largely driven by higher gold prices with competitive cash costs. And the copper business, $1.40 per pound, which is in line with expectations. Next slide, please. Okay, so overall consolidated group revenue, when we compare the first quarter of 2024 to the first quarter of 2025, the major drivers of the difference, that 9.3% drop in overall revenue, is an increase of $47 million attributable to the gold price. MPI and high-grade nickel matte then offset that increase by $112 million. But we do have, with the increased volumes of limonite sales, an increase in revenue from limonite ore sales. Next slide, please. Okay, in terms of EBITDA, that increase in revenue for the gold business at Tujuh Bukit directly translates through to higher EBITDA margin. And you can see that there, $29 million increase in EBITDA relative to quarter one 2024. And copper margin slightly low due to the lower volumes, and MPI margins were up compared to the first quarter of 2024. So overall, that has derived further NPI margin in 2025, and high-grade nickel matte margins contracted significantly with only $242 per ounce margin for the high-grade nickel matte. Next slide, please. Okay, so in terms of overall profitability, this reconciles the EBITDA of $89 million to the net income of $3 million. Depreciation and amortization expense is running at about $45 million US dollars. The extension of the mine life at Tuju Bukit will help reduce overall depreciation and administration expenses. Finance expense is in accordance with expectations, and relatively small overall tax charge given the tax holidays which exists on our Mbma, RKEFs and nickel matte plant. Next slide, please. Okay, so this shows the reconciliation in cash between the beginning of the quarter and the end of the quarter. So we started the quarter with $451 million of cash and finished the quarter of $332 million in cash. Overall, we had a contribution from cash flow from operations, small negative reduction in overall consumption of cash from working capital. And then in terms of the capital investments, we have high pressure acid leach plants, which is really an equity investment into the high pressure acid leach plants, $41 million into the Punny Gold project as we work to try and get production commenced in the first quarter of 2026. The nickel business, mainly SCM, and the infrastructure at SCM was $27 million invested. Tuju Bukit Gold, $14 million, and AIM $11 million in capex as we're nearing the end of the capital investment cycle at AIM. Financing costs, the overall cash outflow from financing costs is higher than what we've showed in the previous page, mainly due to timing differences in terms of payment of financing costs. So on the prior page, we showed $28 million US dollars in financing costs, and on this page we show a high amount, with the difference being working capital. And then you can see there we had bond issuances that largely matched bond repayments in the first quarter, and that left us with a final closing cash balance of $332 million US dollars. Next slide, please.
Thanks, David. So in terms of project development, we're making good progress across the portfolio. We're in regards to TB Copper, in conjunction with the lead consultants, which are DRA and Stantec. We're just putting the finishing touches on some of the optimization work, which will result in a enhanced PFS. Now, I think some of the features of that update PFS will obviously include a much larger ore reserve, which is reflective of the larger indicated resource base, which will lead to about a 65% increase in the reserves. There'll be a substantial increase in the production rate of about 50% in the sub-level cave production to 6 million tons per annum. And that will enable greater cash flow generation in the initial phase of the project, decreasing the project risk. We've also optimized the process plant location, which will be to the north side of the property, where it is the best location to accommodate ore supply from both the underground and open pit ore that's going to be envisaged, and that's being drilled and investigated. In addition, there will also be a management which will factor in additional upside for mine life in excess of 50 years. So we should be in a position to release that sometime in the second half of this year. In terms of the Punny Gold project, as I mentioned, it's about 65% complete as of mid-June, and we should be in a position to start some of that commissioning and mining activity In particular, the stacking activity should commence sometime in the third or the fourth quarter in preparation to achieve first gold pour in first quarter of 2026. In terms of the HPAL operations, Train B is in the process of ramping up, so we should see production coming out of that during the third quarter, and construction at SONC is about 21% complete at the end of May. I might just stop there, and I'll use the next two slides maybe as talking points for the Q&A. So I'll just pass it back to Ryan.
Yeah, thanks, Stan, David, and Teddy for the presentation. This is Ryan from Indo Premier. We will take over the Q&A session from Ryan from Citi. Yeah, maybe just if there's any audience that would like to ask any questions to the management, you can do so by raise your hand in the Zoom, or you can ask your questions via the Q&A chat box. But just to kickstart the Q&A sessions, my first question would be that just considering that the first quarter 2025 is already underway, maybe from Teddy or from David, could you give us a color on the second quarter 2025 performance for both Mdka and Mbma from the operational side? Maybe if there's any indication on what we should expect in the second quarter operational performance and as well as the financial performance. Maybe I'll start there for my first questions. Thank you.
Teddy, you want to start?
Sure. Let me touch on the nickel side. I think if you look back on the 2024 in terms of seasonality, you'll find that first and second quarter generally somewhat comparables. I think you can see that table in the operational activities that we release somewhere in, I think, April from memory. A couple things there, obviously, is if you looked at in terms of the saprolite side, the Q-on-Q per wet metric ton cost, it did increase by about $3 Q-on-Q. But there's a couple of factors to it, as we highlighted in that activity report. B40 obviously increased the fuel costs on the saprolite and limonite. That's roughly, I think, from memory, at about $1.50 to $2 kind of range. So that kind of brings roughly the increase in terms of the Q-on-Q saprolite cost at about 1.4. Now, I think you'll find in the first quarter, the production profile is very similar to the third quarter 2004, where the cost increase on the comparison for the first quarter 2025 versus third quarter 24, that's up by about $0.8 per wet metric tons. But again, the B40 represent about $1.6. So technically, we're able to reduce somewhat the cost on a comparable basis by about almost $1. All right. Of course, there's if you looked at versus the fourth quarter, the cost is a lot lower. Again, higher volume means that you reduce a lot of the fixed cost component for the per wet metric ton basis. And yes, I mean, if you looked at in terms of the year-on-year basis, I think you'll see a very similar on the second quarter also, is that you know, the first half are generally roughly about representable, and then you see a pickup massively more in the second half. So if you looked at even the first quarter year-on-year, in terms of the saprolite, we're up almost triple, right? So I think that underlies the fundamental capability of mining operation we have done in terms of the ability to deliver a much higher volume for any given comparable weather kind of condition. Again, very similar, you see, I think, on limonite, Q-on-Q, yes, the cost was up by 3.7% per wet metric ton, roughly at about $1 or so coming from the B40 impact. So the actual swing is below $3 at about $2.5 to $2.7. But again, keep considering the differences in terms of the volume, that swing in terms of the fixed cost contribution is about $2 to $3. And you can look at that number by comparing the second quarter 2024 to fourth quarter 2024, where in terms of the higher volume, that kind of curved across quite dramatically, right? Now, in terms of, I think, what you expect second quarter, keep in mind also, in the first quarter, the decline in revenue from 444 million in the first quarter last year to 366 this year in the first quarter this year. That's coming from the high-grade nickel matte, right? Because high-grade nickel matte still exists or operating fully in the first quarter last year. We are more tactical, as we have mentioned that a few times in the past, for much of 2025, considering that we will only operate it when the margin economically positive. So that kind of curb a bit on the EBITDA as well, because first quarter 24, the high-grade nickel matte was still making at about over $550 per ton in terms of margin. Now, if you're going to do a comparison on the MBM side on the EBITDA, if you strip out the high-grade nickel matte, you actually see an increase from first quarter 24 at about $20 million in the absence of high-grade nickel matte, to first quarter 25 is about $30 million in the absence of the high-grade nickel matte. So just to do that on the like-to-like comparison. So I think in short, you're probably going to see somewhat comparable-ish in terms of the output profile in the second quarter this year. Of course, slightly higher probably on the NPI as the BSI finish the overhaul and going into a bit more ramp up in terms of the output. However, we do expect in terms of the mining contribution because of the weather condition, because of the full capacity of the NPI in second half, because of the ESG FPP pipeline in second half, we do expect much bigger contribution in second half versus the first half. Of course, consider this is not taking into account any of the nickel price swing. This is just coming from the output alone. I'll hand it over to David on the copper and gold.
Thanks, Teddy. On the copper and gold side, our production level for the second quarter at Tujuh Bukit is expected to be similar sorts of levels to the first quarter. We won't have the benefit of catch up in sales from the fourth quarter of 2024. So our overall EBITDA contribution is probably going to be less from Tujuh Bukit gold. On the copper side, we'll have marginally lower production for the second quarter. It's just a timing issue in terms of extracting the copper ore. We had some stripping that needed to be done in the second quarter, and we get the benefit of being able to stack a lot of additional ore late in the second quarter and going into the third quarter. So we should see probably marginally lower overall performance in the second quarter from a physicals point of view. Obviously, the gold prices continue to improve, but we have had increases in royalty and increases in fuel price, which are largely an external factor driven by the government that will impact our costs. Now, important to note that we've also had an ongoing program that really commenced or ramped up in the second quarter to introduce larger mining fleet at Tujuh Bukit. And the objective of those larger mining fleet is to drive down unit costs for mining as we have lower grade overall for the Tujuh Bukit gold operation. So that equipment commenced commissioning in the second quarter, and we'll see that starting to impact costs in terms of the mining cost per ton in the second half of the year. At the end of the first quarter, we also put out some increased reserves for Tujuh Bukit, which have extended the mine life. So when we first started Tujuh Bukit, we had a 7-year mine life, and we've still got another 5 or 6 years to go, even after we have mined that initial 7 years of mine life. So in summary, I think the second quarter will be similar to the first, but really slightly less in production, but an overall better gold price with some higher costs driven by royalty increase and fuel.
Yeah, thanks, David. There's a question on the Q&A chat box. I think this is from David from CICC. I think he's asking about when the new, I believe he's referring to the pre-FS result of the TB Copper. He's asking when would it be available to the market. Thank you.
Thanks, David. Yeah, so as I mentioned earlier, we're just in the process of finalizing some of the technical aspects in conjunction with our consultants, DRI and Stantec. So all things being equal, I think that should be available in the second half of 2025.
Got it. Thanks, Dan. Yeah, maybe just another questions from my side. I think, David, you mentioned about the larger mining fleet in TB oxide. I'm just wondering what would be the cost improvement from on per ton or per ounce basis on that particular initiative. And my second question, I think it's to Teddy. I think I'm looking at the NPI price right now is already like 11,000 to 1,200. I think if you look at the nickel matte price in the market right now is around 13,000. I'm just wondering whether this is going to be sufficient enough for you to generate economically positive margin for the SGNM, or do you think the gap between the NPI price and the SGNM needs to be larger in order for you to restart the production in SGNM? Yeah, maybe that's two of my questions. Thank you.
I'll start on the mining cost. We're expecting something like a 20 to 25% reduction in overall mining cost from going to the larger fleet. That also allows us to look at different bench heights and different blast patterns. So overall, because we've got that increased 5-year mine life from the increase in reserves at the end of Q1, that gives us the confidence to be able to invest in that fleet, and then it becomes a positive virtual circle in the sense that you then get lower unit operating costs, which allows you to potentially extend the mine life further. So overall, we would expect 20 to 25% reduction in operating costs.
Yeah, so on the MAT and NPI, the margin is looking more healthy. However, Ryan, I think the key now is we are trying to secure that gap in terms of at least for a 6 months basis, right? Because there's no point we got it for today and then tomorrow it narrows again, we have to shut down again, right? So the initiative now is trying to secure that for multi-months at least. It gives us some certainty in terms of the operational longevity to start before we start that.
I'll just add to that. So what we're looking at doing is potentially hedging some of the sales price for the high-grade nickel matte. And if we can do that and it gives us confidence on the margin, it allows us to start. But as Teddy said, you really want to have that confidence over a 6-month period rather than be opening and shutting every second or third month. So that's the key.
Yeah, understood. So basically finding the willing off-taker to, they would like to pay high-grade nickel matte price at this price or even larger one.
Yeah, so
okay.
some of our customers, are quite prepared to agree a certain percentage of LME because they can then hedge the LME and they take the product and then turn it into LME. So we have two alternatives. We can either do a straight hedge in terms of a financial transaction with the banks, or we can lock in a price with our customers or traders, and that's what we're in the process of negotiating, and we made some good progress on that. So there is the potential to restart the high-grade nickel matte plant in the second half of the year, but we need the confidence to be able to do that, which comes from the price we receive.
Got it. Understood. Thanks, Teddy and David. Maybe next question from Ryan Davis.
Thanks, Nip. Maybe I'll begin with my first question. So we have touched on Pani's milestones that have been hovering around 65% progress in terms of per mid-June. Can I actually check if next year target of closer to 80,000 ounces remain intact, or whether we could see potential upside or downside from here? Any updates as well surrounding the CIL carbon in leach plant, and how will you actually fund that? Maybe I'll stop here for my first questions.
So in terms of the production expectation for next year, I think that's a reasonable assumption based on the view that we can start first gold production in the first quarter of next year. There is the potential to maybe stack it at a slightly higher rate, but I think we need to get the plant commissioned and operating in accordance with expectations before we would look to be able to commit to an increased production rate. In terms of the CIL operation, we're in the process of updating all of the pre-feasibility study information. The key issue to finish is really the tailings storage solution, and our expectation at this stage is that there will be an update potentially by the end of the year. And I think at that point in time, we will provide a more comprehensive update in terms of how we intend to fund the project.
Got it, David. Thanks for that. Maybe to my second question for Teddy, can I actually check some colors regarding the nickel ore premium? Because I think in the past like 2 weeks or so, I think we've seen a little bit of pullback recently. Wondering about any sense or thoughts regarding your expectation on where the premium would be hovering into in upcoming months. Thanks.
It's I would always say that I'm no longer an analyst, so I'll prevent from making a forward future predictions. But do keep in mind that from January to June, that premium actually went up by $12, just the premium alone, right? And in sometime in July, yes, we have seen that decline by $2, by the way, right? So it's still if you compare that to the earlier part of this year, it's still very elevated, right? But I think again, this comes down to a very fundamental point that as all these processes and processing facility came on stream, the mining output increase typically lags first because and I think I mentioned, I'm not sure if I mentioned this kind of call in the past, but increasing a mining volume by the order of tens of millions is not a walk in the park, right? It's not just a matter of throwing in more contractors because they need to find the machinery. Mind you, Konawe, our SCM mine, is located 40-50 kilometers from Mbma, and it's about 5 to 7 hours drive from Kendari. So finding the workforce, building the accommodation, building the infrastructure and all that. But I do expect that should the premium remains elevated, you're probably going to see some pickup in volume, and that should somewhat moderate the price because at the current level, I think margin are very heavily being parked or being enjoyed by the upstream versus the processing facility.
Got it. That's very helpful. Back to you, Nip.
Yeah, thanks, Ryan. Maybe next question from Rahul. Rahul, please go ahead.
Hey, good morning, everyone. Thank you, Ryan, for allowing me to for this question. I just have 2 questions. First, could you talk about your conversation with CATL? They just recently did a groundbreaking of the battery plant. Would they be your customers for the materials in the future? And second, in past, there were always a reference of maybe creating a HPAL plant with CATL. Now, would this new announcement revive those conversations? And second, a longer term question, like if we keep on investing in HPAL and you do plan to buy back some of the pending stakes in HPAL, would that mean an equity funding requirement from Mbma perspective? And how does Mdka Copper Gold think from that perspective of investing in more into equity at MBA level? Thank you.
Sure. So in terms of our MHP, we do sell to multiple party. I can't remember if we've sold to CATL or not, but they were part of our buyer list. We do sell that to quite a large number of party from the ESG side. As I mentioned, I think previously as well, in terms of the CATL, right now, I think we will kind of look back into it once we are done with our SLNC project, because Yes, ESG is up and running. Mbma is commissioning and should be up and running fairly soon, heading up to the full capacity, hopefully fairly soon. However, we are currently constructing a 90,000 ton HPAL capacity SLNC, right? So I think at the moment, there's quite a handful on our hand, considering that we also need to kind of make sure the FPP and the pipe on top of the HPAL, all that to be up and running, ensuring that even our AIM project running, thank God now the asset is running at a full capacity, because as you know, that is very important to support the cost of the HPAL, considering that the sulfuric acid price is now over $100. So that kind of focus, I think, would be more important now to make sure that everything that we have right in front of our eyes to be completed. In terms of the additional stake on the HPAL, yes, it will be in the form of the equity investment. Now, I think the illustration I'll put there, Rahul, is that when AIM project is up and running in the full capacity, we are talking to about $30 to $50 million in terms of the quarterly EBITDA. So running it by 1 year, that should somewhat cover all the equity requirement capex by large that we require for the HPAL, which is why I always emphasize that one of the key focus of the management is to ensure that the MTI AIM project to be running at a full capacity, hopefully soon, sometime this year.
I'll just add a little bit. The point to make on the option to buy additional equity is that it was at a pre-agreed price at the time of making our initial investment. So the overall equity investment required to purchase an additional stake in ESG, for instance, is something around 60 to 65 million US dollars. So it's not a huge investment in the overall context of the MBM business. And then once that asset is up and running completely, which we expect to occur by the end of this year, and we're getting the benefits of the additional ore sales that flow through to SCM, it basically, I would say, as Teddy said, over the course of a 12-month period, it's probably not difficult to self-fund that $65 million investment required. Now, there'll be a second stage at the end of ESG, but our expectation is that we wouldn't acquire any further equity in those projects until they have a demonstrated 12-month EBITDA performance profile. So at the end of the day, for us at the time, it represents a very good investment to be making in terms of the level of equity we have to spend for the value we derive from an operational HPAL plant.
Right. Thank you. Thank you, very clear. I was just coming from the perspective that with this new battery plant coming, does it give you a more impetus or boost to speed up or to think about new investments in HPAL? Because I'm assuming that for the current HPALs, which are work in progress or already operational, you already have customers in place. So this new battery plant, is it a potential new customer for you, for which you would like to make more HPAL investments? Thank you.
Yeah, let me take that. I think in terms of potential customer, it's always a possibility. I think when they're up and running, then we will explore them to be one of the potential buyer, hopefully. But if we are to add additional HPAL, I think one of the caution that I need to put there is that even at the current state, we are looking at by 2027, 28 from memory, we will need at about 50 million tons of limonite ore. Now, that's on top of that will be another 10 million tons of saprolite, right? Because you can't mine limonite and then leave the saprolite there, right? I mean, we do have a capacity for 10 million tons saprolite on the RKEF. So we're talking about like almost 60 million ton of ore potentially in the next couple of years' time to fulfill our potential demand that we have on the list today, right? that would make it, from memory, SCM to be, if not the largest in Indonesia, probably in the world. So that's also something that needs to be taken into account. I think Indonesia last year produced at about 230 million tons of ore. If we are doing like 60 million tons of ore, that's like 15%. That's about almost what, 30% of Indonesia production. With Indonesia at about 55% or 60% of the world, we are talking about 15% of the global production. So we would love to, but I think the focus is to ensure what we have in front of us, which is there's a massive amount of standby buyer. We need to make sure that our mining capability continue to ramp up to satisfy those demand of the volume.
Thank you. Very valid perspective. Thank you.
Yeah, thanks, Rahul, for the question. I think I get another question from email. I think the question is to Teddy and also David. Could you refresh the balance sheet capacity for Mbma and Mdka, as well as the capital expenditure requirement for 2025, and whether for Mbma or Mdka to raise additional debt for this year? Thank you.
I'll touch on it a bit, and David, you can take the more detail, right? I think in terms of the financing we do this year, is mostly to refinance some of the project finance, which is more limiting in terms of the term and covenant and requirement. So that would be one of our key focus, to get more favorable in terms of also on pricing, in terms of the financing, by refinancing what we currently have. I believe that at the current state MBM ratio are still more than sufficient, and therefore a lot of the refinancing focus this year is to refinance the existing leverage or debt on the project finance. David, feel free to chime in.
Sure. Thanks, Teddy. I think Mbma overall as a business has relatively low levels of debt, and that will be improved further once we start to see the EBITDA contribution flow through from AIM as expected in the second half of the year. So Mbma per se, I don't think there's a significant issue in terms of being able to raise additional debt capacity. At the end of the day, the margins at Mbma are somewhat lower. But I think as we go forward and we start to increase the overall volumes, we will see the ability to use debt to fund the Mbma business being pretty strong. And we were able to use debt to largely, well, the equity investors in the HPAL plants were able to use a significant portion of debt to fund those plants, because they're very long life projects with pretty solid overall EBITDA margins per ton being generated from the assets. Now, so that's the Mbma business, and as Teddy also pointed out, we have to stage the increase of overall production from the SCM mine, and the additional growth projects we have to make sure that we're not overextending ourselves over the course of the next 3 to 4 years. And that's why I think the focus initially is just to make sure we achieve the increase in mining throughput that will be required over that 2 to 3 year period. Now, in terms of the Mdka business, the Mdka copper gold business, I mean, really it comes back to the question about how we fund our 2 major growth projects. So those are Punny, and we're looking at how we could potentially get some additional equity investment concurrent with debt in the second half of this year. And we're well advanced in terms of what we will do with those plans, but the idea would be to use a combination of debt and equity. I'm not suggesting we would raise the equity at the Mdka copper gold level, and on the Tujuh Bukit project, we're in the process of finishing the feasibility study, and we would then look at how we would finally fund the Tujuh Bukit project. We are looking at potential other investors coming into the project as a way of introducing equity at the same time as potentially using debt to partially fund the project. And I think one of the important things that you'll see when the pre-feasibility study comes out is that we've really focused on trying to increase the cash flow over the first 5 to 7 years of the mine life, so that it helps with some of the reinvestment that's required into the development of the larger project. So we've gone from 4 to 6 million tonnes per annum on the sub-level cave, and we're looking hard at the moment of adding additional open pit material. And if we can do that, then it'll help de-risk the early part of the mine life and generate additional cash flow from that early part of the mine life. So I think there's a lot more information that will come out in the second half of the year, but right now we feel pretty positive about how we take the Tujuh Bukit gold project, Tujuh Bukit copper project forward. And I think you'll see when the results come out that we've made some really good progress on the project. It's difficult to finally commit to exactly how the project is going to be funded, but it's an excellent project, and I think we'll announce more probably in the second half of the year on how we take Tujuh Bukit forward, concurrent with releasing pre-feasibility study results.
Got it. Thanks, David. I think there's this interesting question coming to me is regarding I think you mentioned about like the open pit material and extending the TB gold, TB oxide mine life. Would that mean that extending the TB oxide mine life is somewhat a delay in terms of like the SLC or the BC development for the TB copper, or do you think it's more like in parallel development? So in addition to extending the mine life in TB oxide, you can also develop the SLC development for the TB copper.
We can do both in parallel, and that's the plan. Bear in mind it will probably take 2 years to ramp up from the moment that we make a decision to achieve first underground ore production, and then probably a little bit longer to reach the 6 million tonnes per annum production level. But we see that we can we have time to be able to complete both of them. Now, if the oxide gold project extended for another 5 years, that might be a little bit more problematic. But at the moment, it will reach a point where you're better off focusing on the underground. But it's in this gold price environment to have that 5 to 6 year mine life with the potential to add further to it, I think is a very positive development overall for the business. And we do think we can do both at the same time over that period of time, and probably for another 1 or 2 years after that.
Got it. Thanks, David. Maybe since I think we are getting closer to 9 o'clock, I'll hand it back over to Ryan.
Yeah, I think just like one more checks coming from my end. I think this is with regards to your overall guidance on MBM and also Mdka copper gold as we have actually concluded second quarter. I'm actually checking whether you can reaffirm the guidance that you have basically given to us earlier this year.
I think we'll keep the guidance for now. Should there be any changes, we will reflect that in the second quarter operating activities, which I think is more appropriate, considering that most of the guidance also on their production. And that covers, I think one of the key reason we opted to do that, at least that covers like the first half, right, in terms of the actual numbers, before we kind of reaffirm or making any slight adjustment should there be needed on the guidance side, rather than on the first quarter call, we thought.
Got it. I think that would be every questions that we have at the moment. checking from investors for any last questions before we conclude the call. Okay, I think this will be the end of the call. Thank you so much, management, and also Ryan as our co-host. Yeah, this will checking if there is any closing remarks, perhaps. Otherwise, we'll end the call here.
Thank you.
Thank you.